Well, good evening, everybody. Thank you very much for joining in. This is 64th in the series. We're going to speak about a topic which is known as proprietary trading. I'm Rahul Magan, working as a corporate treasurer in EXL Services India, which is an Indian counterpart of a US Nasdaq listed firm, EXL Service Holding (INC). At the same time, I'm working as a proprietary trader I'm acting as a proprietary trader in India, covering BSC, NSE, and MCX. You're most welcome to join my 62 million LinkedIn networking at rahulmagan8@gmail.com. You're also welcome to join my FX group, which is Foreign Exchange Maverick Thinkers, having 2,400 FX group members. You're welcome to see my YouTube networking, which is 62 technical videos and roughly 3,100 video views and 82 subscribers. You're welcome to join my group on Facebook, which is Foreign Exchange Maverick Thinkers, and you are most welcome to call me at 9899242978 in that regards. Well, again, reiterating, I started as a proprietary trader, and today I'm going to give you a small hint about how to trade a currency future in India. Now, in this, we're going to cover an example which is hypothetical in nature, but we're going to cover an example of November currency future, then how you're going to trade that. Now, take a very simple example. Assume INR is working as 61 to 61.50. This is bid and ask. Now, bid stands for exporters, sell side, and ask stands for importers, ask side, import side. Assuming the currency futures, November currency futures is nothing. We are taking an example of November futures. November currency futures is nothing. Spot plus exchange premium. Exchange premium. Now suppose that turned out to be 61.30. How? We are assuming 61 is the spot plus 30 paisa. So that turned out to be 61.30. Now you want to trade. Now assume you are taking a prediction that INR would go up. It means you are biddish. You are thinking INR to go up. So what you are doing? You are buying November futures. You are buying November futures, and you're buying November futures at 61.30. Now during the day, INR we are taking 3 rate. Assuming during the day INR turned out to be 61, spot turned out to be 61, it remains intact. Spot turned out to be 61.10 or spot turned out to be 61.20. If spot turned out to be 61, then the November currency future would be 61 plus 30 paisa, which is 61.30. 61.10 plus 30 paisa, which is 61.40, plus 30 paisa, which is 61.50. Now in this, there is no profit, no loss, because there is no need to do a trade. However, you're going to lose the brokerage. Brokerage is on both the sides of the game. However, if it is going to be 61.40, you are going to get a gain of 10 paisa because you bought at 61.30 and it is 61.40, so you would have a gain of 10 paisa, and here you would have a gain of 20 paisa. And assuming that the deal which you are doing, this deal is of 20 lots. So one lot is equals to $1,000 and 20 lot is equals to $20,000, which can also be referred to as a $20,000. Now you would have a gain, assuming this is the scene, which is 20, you would have a gain of 20,000 into 20 divided by 100. This is the total gain you would have, which is roughly, if you take, which is roughly 4,000 rupees. So you would have a gain of 4,000 rupees in your books. This is the simplest example of proprietary trading. In India, currency futures can be done in INR. INR refers to USD INR. It can be done in GBP INR. It can be done in JPY INR. And it can be done in Euro INR. As a proprietary trader, one thing which you have to always take into consideration is the stop loss principle. So assuming you are buying 61.30 and market starts falling. Markets, irrespective of going to 61, market go to 60.50. Then you have to take a stop loss of 10 to 15 paisa. Wherever do you think the stop loss is getting active, you should reverse your trade. Because if you are not taking a stop loss into consideration, then you would lose the show. You will lose the show. And this is the most simplistic example of a currency futures. Now, assuming, now one more thing which we have to take into consideration while dealing in currency future, which is nothing but M2M and restatement of value. Now, assuming it starts falling, it starts rising, it is 6130, you sold at 6130, and markets and the spot principle, suppose the spot goes to 6150, 30 paisa premium would be 6180. Now you are in a big gain of 50 paisa. That doesn't mean that you have to basically honor your contract. At an end of a day, which is 5 p.m. IST, you let your contract to be rollover for next day, and for rollover, what you need to do, you will get a gain, you will get a M2M gain, and you will get a M2M gain of 50 paisa here. You would have M2M gain of 50 paisa here. Mark to market is done on a weighted average rate, and at the same time, the rate as which you hedged, which is 6130, this rate is going to be restated low. So in case of, basically you would have gain of 50 paisa, it's going to be restated to a lower side, because you bought it, you would have a gain, it would restate it. So the restatement of the rate and the M2M would happen if you want to roll over your trade. This is the simplistic example of currency futures. I am again reiterating the fact that currency futures can be done in USD INR, it can be done in GBP INR, it can be done in JPY INR, it can be done in Euro INR. And as a proprietary trader, you should be very careful, because you should know how currencies are moving. GBP INR, JPY INR and Euro INR, they are nothing but a cross currency trade. So need to be very particular about that. Cross currency trading should be considered very carefully, because in cross currency, two legs are going to be against each other. So this is a small example of proprietary trading using currency futures. You're most welcome to email me, call me at 9899242978. Thank you very much, and thanks for your time.